Welcome, everybody, to the Bitwave and Figment webinar on accounting for digital assets. We're going to go ahead and give just everybody a couple seconds to fill out in the room. If you guys want to go ahead and answer the poll we have at the very bottom, the poll question is, do you already have a US GAAP compliant subledger? Kind of give us a temperature check of the room. And if at any time during the webinar you guys would like to ask a question, we also have a tab next to the polls for asking a question. If you see the question that you would like to ask already in there, you can upvote it, and we will get to those at the end. But feel free to ask whenever the question pops up for you. All right, 50 people, awesome. Where are you guys coming in from? Awesome, all right. Seattle, DC, nice. All right. Well, welcome to the Bitwave and Figment webinar on accounting for digital assets. Joining us from Bitwave, we have Joe Dillon. Joe's a CPA, a certified fraud examiner, and an NFT enthusiast. Joe joined Bitwave after spending 12 years in public accounting. Joining Joe is Mackenzie from Figment. Mackenzie's a CPA and loves the intersection of accounting and digital assets. She joined Figment over a year ago, shortly after graduating from the University of Florida. In this webinar, we'll go over how to set up a subledger that is compliant with US GAAP. We'll also go over the Bitwave and Figment journey, the importance of data collection, principal market pricing, categorization, rules, impairment, and beyond. But before we venture down the rabbit hole, Mackenzie, can you share with us the journey Bitwave and Figment has gone on together to get to where we are today?
Sure, and thanks for the intro, Chris. But first, to back it up, I think it's helpful if we first describe a little bit about what is Figment and what problem were we actually trying to solve when implementing Bitwave. So just to back it up, Figment is a leading blockchain or leading provider of blockchain infrastructure. So that means that we support staking or validation on over 65 proof-of-stake networks. And so we have pretty reliable infrastructure, we have deep expertise in the staking world, and we also have a protocol support team in addition to slashing insurance. And so I always like to say that protocol staking is a really great option, especially during a bear market, since you can earn a pretty reliable rewards rate on your principal amount of tokens that you're staking with us. And so to talk about more about our journey with Bitwave, we've been working together, I think, for about a year now. And our whole goal, we wanted to set up a subledger that was compliant to US GAAP. And so as you can imagine, trying to do that when you're validating on over 60 blockchains is really difficult just due to the volume of data and the complexity of each individual chain that we're staking on. And so also the guidance itself is always changing. And so it was really helpful to partner with Bitwave. When we first started working with them, it was more just like their more basic solution. But then as the time went on, we figured, wow, like we're adding so many new chains per month, we actually need more of a custom build out. And so that's what we're doing with Bitwave today. And so custom build out just means that Bitwave is are actually building or syncing in the data for the different chains that we're on, which makes it really helpful, especially on the accounting side, because a lot of it is not as manual now, which is really helpful for us. So I guess, Joe, I'm curious, what would you, or I guess what about Figment made you want to do a custom build out for us? Because I know it is no easy task.
Yeah, I think the short answer is everything about Figment. So just like the very nature of operating across 60 different networks. What it means is like we have to gather data from so many different sources, and everything that's happening on each one might be a little different, right? Like you may be, Figment is receiving rewards, but that's going to be on a different cadence on different networks. You're going to recognize revenue different. You're going to have all these different sort of like nuance of each thing. And so I think it's sort of indicative of what we're seeing a little bit in the industry, which are, more and more sophisticated, players in the space like Figment. And what we find kind of over and over again is like to really serve the needs there, it kind of has to be a custom implementation. I think this is a good time. And thank you, by the way, for the intro. That was nice. You said I'm an NFT enthusiast, which I am, but that was also much cooler to say when I wrote my bio like 9 months ago. So, I guess, I'm holding a lot of bags and I'll deal with that.
I think it's cool, Joe.
Thank you. So I think, the one thing I wanted to mention is like, kind of approaching this webinar, if you're listening in from wherever, of really keeping in mind your organization and sort of what your specific needs are. I think as you kind of like approach setting up a subledger solution for digital asset accounting, you kind of need to know, like, okay, do we need to be GAAP compliant? Like, do we need to be, or do we just need to do this for tax purposes? Are we going to have IFRS reporting requirements? Are we, exactly where do we need to go? What is our activity? Are we a mining organization that like all we do is mine? It's really straightforward. We do this. Do we want to do all these other things? So I think it's just keeping in mind sort of like the end goal or what your end requirements will be. Will you need to get an audit? Will you need to, can kind of help you in the design phase at the beginning of setting up your subledger system. I think crypto has a nature as an industry to be like a move fast and break things, which is great. It makes everything very exciting. But for my accountants in the room, if you're the one trying to pick up all those broken pieces, it's really hard. So I think what we try to, as early as we can kind of grab folks in their process of setting this up, we try to talk about like, all right, what's the end state of this? Like, what are you going to need? And it helps a lot in the design setup. The other point I wanted to make, because sometimes we get this question of like, why do I need a subledger anyway? Like, can't I sort of like brute force some of this activity into my existing ERP? And, the answer is sometimes yes, if your activity is like really low, but the ERP systems that are out there, your NetSuite, your Sage, your SAP, they're not really designed to handle digital asset activity. And we'll get into part of why that is. But I think operating a subledger has this additional benefit of control. So like, as Mackenzie, how many transactions does like the Figment Solana validator have?
We have thousands per day. Honestly, I think even per like every couple of hours. And so if we try to push that out to QuickBooks would just break. So we can't do that.
It's impossible. You don't want that, and it can't, and you don't want it, right? Like, you don't need a transaction you don't need a journal entry for every single on-chain activity. And by operating a full subledger, it kind of puts you in the control seat of like, okay, hey, we still want to capture the transaction level detail for everything, but it gives you a bit more control of what happens with it next. Do we want to batch together things on a daily basis to push over into our GL? There's all these sort of like decision points that if you're operating a subledger, you have the ability to kind of tweak and pull different levers. I think we could probably get into like our next slide, which is what we view as like sort of the first step of any engagement, just like the one we've done with Figment, which is data collection, right? So you have your digital asset activity all over different networks, especially in the case of Figment. And so the question is always like, how do we capture the data? And capturing the data is capturing the transaction details. So if you've ever operated on the Ethereum network and you've looked at Etherscan, you can go and you can look up all your transaction details. Well, we need to get that into a system. And we also need to get your Bitcoin activity and your Solana activity and your every other chain activity and bring that into the same place and kind of overlay it on top of each other. And oh, by the way, do you operate on exchanges? Do you have an FTX account, like Gemini, a Coinbase? Those are all data sources that we need to grab, and they don't do all their stuff on chain, so you have to get them directly from them. And so what we end up with is sort of this like web of data points that we're grabbing different things from. And that's part of our sort of setup process at Bitwave, is figuring out, where do you have activity? Where can we get the data? Like, is there reliable data out there to grab? How does it all intermingle with each other? Is it all on chain? Is it all from third parties? Do you have internal databases that we need to incorporate as well? And so what we try to do at Bitwave is kind of normalize that and put it in one source. But that's if the data is sort of like available. I think, Mackenzie, you probably have a lot of experience dealing with sources that are, I would say, less available.
Yeah, exactly. So Bitwave does do a great job of pulling in data sources for the chains that they support. Like, of course, Ethereum, Bitcoin, the bigger ones, and now Oasis and like some other ones that they've built out for Figment, which is awesome. But at least on Figment side, we still run into an issue where we do have blockchains we support where no subledgers are automatically syncing this data in. And so then you have to go to the next step, which is you have to pull this data manually and then manually upload it into your system. And so I'm going to drop a link in the chat real quick. So this has way more detail than you probably ever need to know about how to pull manual data and bring it into your subledger. But I would definitely refer to that if you're in the same boat or you just have a chain that for some reason is more obscure and other subledgers just don't support. And so I just want to run through kind of high level the steps on how to actually put in manual data, because you still need it. Just because a subledger doesn't support it doesn't mean that you don't need it for accounting purposes. It just will take a little bit longer and just take a little bit more insight and scrubbing on your part. And so just real quick, the first just wanted to go over is sometimes there's data that a block explorer might not show or that a subledger might not have. And so this is called the Genesis file. And so Genesis file just refers to when a blockchain actually starts, it starts off at a certain point in time, at a certain state. And so like this account might have X tokens, whereas this other account might have Y tokens. And so the blockchain just sort of starts at this beginning point. And so if you're like Figment, for example, and we participate on a lot of incentivized testnets, we might start off upon mainnet launch already with tokens. But like a Bitwave or any other subledger really isn't going to pull that because it's not really an on-chain transaction. It's baked within the protocol code itself, baked within basically the first block. And so if for some reason your accounts aren't reconciling, I really recommend looking into the different Genesis files or the blockchains that you're on, because you might find that you got some tokens or an airdrop right in the beginning that you weren't able to find anywhere else. And so I always like to mention that one because it's kind of obscure and often overlooked. And when I was reconciling all of our accounts, I was like, why are these accounts not tying out? And it was because of these sort of sneaky day one transactions that were put in. And so the next part related to that is finding just reliable block explorer, because if you don't have a system that's pulling in your data, you'll have to get it from somewhere else. And at least in our world, that's going to be a block explorer like Etherscan, as Joe mentioned, or Mitscan if you're on a Cosmos-based network. So this is where you can actually start to pull in your transactions. And usually they have detail like what's the transaction hash, what's the time, who's the to and from, and the amount. And so you can use that to sort of fill out the template that you'll then upload to a Bitwave or another subledger. And so you can pull that manually. You can build a Figment. We built some scrapers as well. So it wasn't just like copy and pasting, but you'll have to do some sort of manual input to get all this data. And then there's other more, I guess, more individualized activity depending on the nature of what you're doing on the blockchain. But you could have a vesting schedule. If you did participate in some sort of grant, you could have a vesting schedule on that. If you stake, that's also some other activity to consider. Staking is pretty interesting because it actually shows as like an outflow, a transaction that's an outflow because you're sending it sort of into a staking contract, but it's still on your balance sheet, right? You don't want to just show that as a pure outflow. You still want to record that activity. So that's just something to be aware of. And then there's also other things like liquidity providing, and that gets really tricky when you're trying to pull all this data in manually. And so definitely recommend checking out the article because they'll have kind of like a how-to guide on how to do that. And so the point that I really wanted to make is that the accountant isn't just the accountant if they're doing crypto transactions. They're really more like a detective or like a protocol researcher, or I say like a forensic accountant almost, because you really have to understand like, what is this blockchain doing? Like, what's its purpose? What was our historical activity on it? And you really have to understand the full picture of your entity's activity on it in order to account for it properly. And so usually I'm either on like subreddits or on Twitter and like trying to get information about these blockchains that I'm on, because it's really hard to get this information anywhere else. A lot of it is just Googling, to be honest, to figure out like what our activity actually was. And so there's other things you can do. Like I really do recommend, documentation as well, and communication between usually the engineering team or like your DevOps team that is actually executing the transactions and the accounting team that's trying to actually record that activity. Usually there's a disconnect between the two. So I really just recommend over communicating with your engineering team, getting all the documentation that you can, because as the accountant, you really have to understand like what's going on in your wallets. And so I did mention the staking treatment real quickly, but I just wanted to highlight the Bitwave has a really great feature just to do this automatically. And so it's called the DeFi treatment that they have. Some of you might be familiar with, but it's really helpful in the data collection phase because it refers to that balance sheet treatment I was referring to. And so if you're staking some assets, let's say you're staking some Atom, instead of showing the amount that you're staking is just a pure outflow, you can apply the DeFi treatment. And so it actually just stays on your balance sheet, but you can tell, oh, this is staked. So you kind of like separate the two assets so you know like what's being staked versus what's still liquid. And that's important to know. You might need it for disclosures or other information like that. And so, as you can see, the data collection process is super, super important. It's really the foundation for setting up your whole crypto subledger. Because if you don't have that, then trying to do accounting is going to be really, really tricky. And so, both on the automated side and the manual side, the accountants sort of see the whole picture of it.
Yeah.
But with that, I think we can go.
I wanted to add one thing there. Your point about the manual sort of detective work is such a good one. I think, especially for an organization like Figment, that is like what I would call an early adopter of a lot of networks, like whether it's Bitwave or any platform, like we can never add support for networks as fast as they are created or as fast as an organization like Figment can adopt them and start using them. So even if like it's like, well, hey, we only operate on these couple like, networks that are very popular, the data is available. That may not always be true, right? And so you kind of have to think about that. We think about that a lot in our like sort of like setup of an organization of like hey, I want to get involved in DeFi. Well, you can do DeFi on a couple different chains, right? So where do you want to do that on? Do you want to consider the availability of that data in figuring out where you actually want to carry out your business? It's, you think about that in your wallet setup. You think about that sort of just as you make sort of operational decisions. And whether it's automated or manual, your point about the accountant as a detective, I think is so good because Mackenzie, how much time do we spend validating data, right?
So much time.
So much, because for a lot of these places, there is not a like genuine source of truth. It's like you do have to see what data is coming in. How does it compare to what you expect? Even things like, API connections to exchanges, like, oh, by the way, like the exchanges aren't perfect. Sometimes they put out goofy info in the, via their AP in the APIs that we call. And, you have to be very familiar with that data and know what you're looking for, understand what it is so that you know if it's accurate or not. Maybe at some point as an industry, we'll get to a point where like everything is normalized, their standard API outputs, but we aren't there now. So like, at Bitwave, we try to just be like, okay, let's grab it from everywhere, normalize it, make it usable, and kind of house it all there. But whether it's automated or manual, that detective hat, I think, as the accountant is a really important point. Mm-hmm. I think we could probably move to like the next step of this, which is like, okay, we've captured your data. We've got all your transactions, and you can actually see it on the screen here. This is a screenshot of what like a single transaction looks like in Bitwave. So in this case, this wallet had received some Mina tokens, and so Bitwave identified that transaction, and then the bookkeeper is going to do their work, which we'll get to in a moment. So what is the next step? It's like, okay, you've got your transactions. What are we actually trying to do with it? The next piece is pricing. So like we got to price it, right? Because you can't, the IRS will not accept your tax return priced in Mina. It will not. You might try it, let us know, but like I don't think they will. So like we have to convert everything back to a functional currency. For most folks that that are trying to follow US GAAP, that's going to be US dollars. So we can go to the next slide here on pricing. And I think what we talk about is when we talk about how to price things, there's a lot of considerations. And this is where you kind of have to know, what are your needs? Do you have to follow GAAP or do you not? Because if you don't, you got a little bit more flexibility in how you want to price things. You want to price things based on Binance prices? Great. You want to price it based on Coinbase? Great. You want to use maybe a market average price? Sure, you can get away with that. You have a little bit more flexibility sometimes with tax purposes than genuine US GAAP. If you fall into the US GAAP bucket, you're like, oh, shoot, we're definitely getting an audit. Well, now you have to start thinking principal market. And so, for the accounting standards essentially say, you should be pricing your assets based on the market that has, the greatest volume, the greatest level of activity that is available to you. So what that means is that the standards are literally telling us you may have to price your assets based on some exchange's price that you don't transact in. So maybe you transact on Coinbase, but the principal market for a particular asset is Binance. So you should be and it's really just this, the accounting rule for principal market is not that for principal market accounting is not that complicated. It's just the fact that crypto can be traded in so many places that, like, in traditional, equities like stock trading, it's much easier to determine what the principal market is, and so what prices you should use. As you know, you got some ETH in your pocket, you could go trade that a million different places. So, and they're all going to have slightly different prices. So which is the correct one? Which is the principal market? What is the truest representation of that asset's price? That's what the standards are trying to get at with principal market pricing. It's just that because of the nature of crypto, there are a bunch more hoops to jump through. So Mackenzie, how did you, obviously, if you're staking on 60 different networks, y'all are holding a lot of different tokens. So how do you approach, with sort of the landscape being so wide like that, how do you approach principal market considerations at Figment?
Yep, that's a great question. If we actually go to the next slide, we can actually see this is just a very small snippet of possible sources that you can get pricing from. And so, as Joe mentioned, we have so many different assets. And so we actually hired an external consultant to help us with this principal market analysis, because it would be a really large undertaking for our team to do internally. And so we did look at factors like what's the volume in this market. And we also looked at accessibility to the market. And so to the first point, volume, we get a lot of tokens early on, for example, for the testnet rewards that I mentioned. And so early on, if we were to sell all of our tokens in one market and then would have caused that market to crash, then we can't actually use that as a principal market, because we can't actually sell our tokens there, because it wouldn't be a liquid enough market. And so we had to look at scenarios like that. And they also look at, accessibility to the market. So do we actually have access to this particular exchange? And so for some reason, some exchanges don't support Canadian entities, and Figment is a Canadian-based company. And so in that case, we wouldn't be able to use that exchange's pricing, because we simply couldn't access that just based on where we are geographically. And so we definitely look at factors like that. And then along with pricing, you also have to look at, well, what if you received tokens before there was actually any sort of traded price for them? And so if you're a validator, again, this tends to happen fairly often. If you got tokens early on, if you got a grant early on, there's usually not going to be a price, because when a blockchain launches, like mainnet, day one, there's usually not a price. There's just not enough liquidity for a price to be publicly traded. But there's a few things that you can do if there's no price on a popular exchange or something like that. The first one I always like to say is look to see if there's any DEXs like Osmosis. Figment's super heavy in the Cosmos ecosystem, and usually Osmosis starts supporting these Cosmos-based assets pretty early on. And so we can get a DEX price. And so, of course, it's up to you and your accounting policy on whether you allow your assets to be priced according to a DEX. But for Figment, we use Osmosis for some of them. And then also look at other price aggregators. So instead of choosing like a Binance or a Coinbase, or they just don't have prices on there yet, I would look at other price aggregators like a CoinGecko or a Nomics or a CoinMarketCap. Usually the more popular ones that you'll see. If that has a price, they are pulling it from somewhere, because they're aggregating prices from multiple exchanges. It just might not be one that you're super familiar with. Then if there's a price, we'll default to that one. One that's actually really interesting is private valuation. So if for some reason you have a SAFT or a simple agreement for future tokens for a blockchain that hasn't launched yet, sometimes these private blockchains or blockchains that aren't public yet, they haven't actually launched, sometimes they'll have their own valuation price stated in a contract. So then that's kind of the next lower order pricing that you can default to, because they just went out and got a valuation specialist and got their own price for that. And then the very lowest layer that we go to is a labor cost analysis. And so this is super heavy in the weeds, but for validators, you can actually do this. So if, for example, we spun up a validator on testnet and we don't really have a lot of data around pricing or anything like that, we can try to model it out and look at what was the labor involved in spinning up this validator, what's the cost of the server that went into this, and look at factors like that to try to come up with, well, can we price it based on the cost that it took to actually perform this work? And so typically that gets to be a little more in depth or in detail. And so if there's a price from another source, we'll use that. But if really there's no price, but we did earn revenue, we just don't know what to price it at, then we'll do some sort of analysis like this. It just tends to be a little more intensive. Yeah. So as you can see, pricing, it can come from a lot of different places, but it's super important.
It's a lot. And I just want to clarify what we mean here is you may literally have a different pricing source for every single asset. So if you have 50 different assets, maybe 10 of them, the appropriate principal market is Binance, and 10 of them it's Coinbase, and 10 of them it's, these different DEXs. So you have all of these things. So it's even just pricing the assets, all we're trying to get to is US dollar values. We got to report in US dollars. All we're trying to do, and that's part of what we try to do at Bitwave. I'm sure if you heard everything Mackenzie just said about like how they actually think about pricing, there's a lot of moving parts. So we view our role in Bitwave as like, okay, we've captured all your data, we've made it usable, we've brought it all in this same place. Now we got to be flexible as far as pricing. So whether it's using any one of those data sources or even just like direct from Figment itself, like, right, hey, we had an agreement to purchase tokens at this price, whatever it might be. Okay, yeah, use that price. Bitwave's you're not gonna find that price anywhere out there, on any of these markets. But so that's how we view our job at Bitwave, is to just flex accordingly. This is where I get the benefit of being able to say like, well, look, I'm not your accountant, I'm not your auditor. Like, talk to them and figure out, the correct determination of these markets. And then our job at Bitwave is to just, flex everything accordingly. But, even then, like Mackenzie, you figure out all that, you figure out all your pricing sources. Can you just keep those principal markets forever, or do you have to reevaluate?
I was just about to mention that. So yeah, principal market is not static. It can change like fairly quickly. And so again, it kind of gets back to your accounting policy. Like, how often do you want to see, like, if your principal market has changed? It should be at least like once a year, but you might want to do it often because crypto changes all the time. And so you might have to go through this analysis maybe every month if you decide, or every 6 months. So your principal market on day one, not going to be the same probably on day like 400 or day 500. It's always going to change. And so you just have to communicate with your subledger. Like, Bitwave will tell them, hey, like, our principal market changed from like Coinbase to Kraken. So like, can you update this on the back end? And then they'll go ahead and do that, which makes it a little bit easy. But the hard part is actually just knowing when it's actually changed. So yep, very dynamic.
For sure. And so it starts to become very clear, like, I think we start off with like, well, why did this have to be a custom like implementation for Figment? It's like, well, if you walk through that data capture part and you walk through all these different pricing variables, it's like, okay, we're slowly checking off the boxes, but each one of these, there's so many different decision points. So I think let's go to the next part, which is about what we call categorization and rules. So this is like where, okay, we've captured your data, which again, here means like your transaction data. We've got all the stuff you did, everything you sent, everything you received. We've got it all. We've custom tweaked all of your pricing sources, right? For every different asset. So now we're pricing everything how you want it. So everything translates to US dollars. But there's still like this thing to be done, which is really like kind of the heart of the whole thing, which is what we call categorizing at Bitwave, which is telling the system, what is this for? So, hey, we received these assets. Was it revenue? Great, it's revenue. Was it sales revenue? Was it royalty revenue? What is it? Hey, you sent out these assets. What are they for, right? Like, is it for labor? Is it marketing expense? Whatever it may be. That is like the heart of, I think, like the bookkeeper's role here of telling the system, hey, we have all this transaction data. What is it for? And this is where we're tying into your existing activity, your existing general ledger activity. I think our goal at Bitwave is to sort of like be able to incorporate your digital asset activity with your non-digital asset activity. So that's what we do. We capture all your data, we price it. Then now through categorization, we're going to start producing journal entries. We're going to start choosing general ledger accounts, expense and revenue accounts that all of these transactions are related to, and then feeding that information into your ERP, into your GL, so that it is married in US dollars with everything else, so that you can run, a single set of financial statements out of your ERP system, and it's reflective of everything. And I think, that's simple in thought. Like, if you looked at my activity, it's like, yeah, Joe, you're doing a couple of transactions here, and they're pretty easy to figure out. But if you're somebody like Figment or anywhere in between, and the volume starts to get high, it can be a lot of work to manually go transaction by transaction and tell the system what's it for. So that's where we really leverage something that we call rules. And that's what you see a screenshot of here, of like how someone would set up a rule in Bitwave. And it's the ability to tell the system, hey, treat like-kind transactions like this. So like, let's say you have a wallet that you're receiving royalty revenue. There's an NFT project, something, say, and they're receiving royalty revenue pretty regularly. You can set up a rule that says, hey, anytime this wallet receives ETH from this address, automatically categorize it as royalty revenue. And so for every one of those transactions, we can create, push that transaction into your ERP and produce a journal entry that's going to record that royalty revenue. Now, this sort of goes back to what we talked about at the beginning, which is like sort of being thoughtful in your design and setup. Because if you can imagine for a minute, an organization that does a lot of different things, having different wallets set up for different purposes makes it a lot easier to categorize rules. Because like in that example that I used, it's like, well, if you're receiving royalties from 5 different projects into the same wallet, or receiving other ETH for that, I'm using ETH as an example for all these different purposes, it becomes a lot harder to like tweak the rules to like automatically trigger these like categorizations. Where if you have wallets set up for unique and individual purposes, like, hey, this is our like, this is our DeFi compound wallet. We do borrowing and stuff on compound here. This is our wallet that we do that. This is our wallet for receiving royalty revenue. This is our wallet that we pay vendors with, right? All these different things. And you can set up rules based on like custom, addresses. So it's like, hey, if we know every time we send ETH to this guy, it's marketing expense, you can set up the rule accordingly. But it is being thoughtful at the beginning with your wallet setup, setting up those individual wallets and accounts based on the specific purpose that makes this a lot easier. If you got everything all jumbled into one all over the place, it becomes real hard to like effectively run rules. And I think, yeah, Mackenzie, can you speak to that of kind of how you approach from an accountant standpoint of like figuring out what transactions are for?
Sure. Yeah, I love how Bitwave usually calls it good wallet hygiene. I think that's just a great phrase and just super important, because I found that in like a lot of crypto startups or crypto projects, the accountants tend to come on later. And so you have these wallets that maybe don't have great wallet hygiene in the beginning. And so the accountants, again, have to put on their detective hat and sort of disentangle all the historical transactions that have happened. And so what Figment did on the categorization and the rule side, so it was a little trickier for us because Figment was started in 2018. And we're just starting this process now in 2022. So that leaves almost like 4 years of data that we have to go through and try to figure out what everything was for. And so the way that we approached this problem, since we didn't really want to categorize and go into detail on every single transaction for 4 years, because that would take a really long time, Bitwave actually has a really great feature where you can like lock in certain beginning balances. So let's say as a 12/31/21, your ending balance is going to be X, and then you can go on and then categorize at a finer detail from that date and then going forward. And so that's exactly what we did. We're just locking balances down at the end of 2021. And then from there, doing the fine tuning and categorization for 2022. Now, this only works if you're like super certain that your ending balances are correct. And so that's where the Bitwave team and I have worked really closely together, trying to tie out every individual wallet and saying like, this wallet had an ending balance of X, like how certain are we that this is correct? And so that involves either doing manual reconciliations, going to block explorers, trying to tie it out, and just comparing like what Bitwave is showing to what we have in our own records. And so luckily we're able to do that for all of our wallets, which made me super, super happy. And then from there, yeah, you can just sort of lock those balances. And then Bitwave also has another feature called mass categorization. So what that means is that you can just mass categorize all transactions from a certain point and before that. And so that way you can still run different rules like impairment. You can still run those features because they require categorization. But instead of manually going through like individually categorizing each transaction, you can just mass categorize it and put it to some other sort of, we call it like a dummy account. And so that was really helpful for us because it allowed us to be pretty confident in our ending balances, but we're not really required to fine tune or categorize every single transaction in there. And so we were able to still have like a high degree of confidence without doing all that work. And then for 2022, that's when we can actually go transaction by transaction and categorizing it. And so I thought that was a really great feature, especially if you've been around for a while, but accounting wasn't really set up right at the very beginning. At least now going forward, you'll have a really solid system and know that your historicals are correct, which is really great.
Yeah, we're trying to make it easy to make that catch up, because it can be daunting, right? You plug in a wallet to Bitwave that has transactions back to like 2016, and it's like, I don't know what I ate for lunch yesterday. How am I going to figure out like what this transaction from 5 years ago is for? I think one thing I'm curious for your opinion on this, Mackenzie, because it's not unusual for us to meet with new customers who are still trying to like maybe setting up this back office function. And I'll say, okay, like walk me through like a typical transaction flow. And I'll pull up like Excel and I'll start like, right. And it's a lot of times the first time that they've actually kind of put pen to paper on like documenting what their actual like sort of like, I say like these things are like revenue cycles. You should document them like you would anything else in your business. But I think documentation, and maybe it's part of that crypto ethos of like move fast and break things, that documentation always seems to lag. How do you think about that at Figment?
Yeah, so I think Figment, we're pretty unique. We do have a bunch of different blockchains we validate on, but staking, if you look at it from a high level, is pretty similar across all the different chains. So we operate a validator, we earn staking rewards as commissions that usually drops into our validator wallet. And from there, we either leave it there or we redelegate it or we sweep it out to like a main custodian wallet that we have. And so the revenue cycle is actually, it's fairly easy to understand from a high level. For us, the main challenge is the volume and sort of the breadth of all the networks that we support. And so we're definitely starting to do a lot more documentation around our revenue cycles and sort of what that looks like. But for us, at least, I think it's a little bit more simple than maybe some other entities that might dabble in a bunch of different like DeFi projects, for example. Like we pretty much just do staking. And so from an accounting perspective, it's the documentation applies to all of our networks. But yeah, it's not as bad as it could be, I will say.
Yeah, well, and I think that speaks to like what we've been talking about, right? Is like these sort of operational decisions of the type of activity that you're going to carry out. You can kind of think ahead of what challenges that may create accounting wise. I think that makes a lot of sense. I think we're probably good to move to the next part that we wanted to touch on, which was, for us, it's impairment. And so, impairment is a really, I think, well, it's a hot topic in my life because I have a very, exciting life. So impairment of digital assets. If you're not familiar, it's the idea that, the accounting standards say if you have an intangible asset, you need to test it for impairment, which is essentially like, did the value of the thing go down? If it did, you should book a loss for it and report it at that reduced value, because it would be misleading to report it at its higher value that is no longer relevant. That's kind of like the spirit of I think the regulations. But what's sort of interesting about digital assets and crypto is that because of the current regulatory environment, they are categorized typically, for US GAAP purposes. Now there are edge cases, there's different times where there's different classifications, but for the most part, they're indefinite life intangible assets. And the standards say if you have indefinite life intangible assets, you have to test them for impairment. So now we have these assets that are at times, as you know, highly volatile, that we are applying this like process of impairment to that. If you ask my personal opinion, when the impairment rules were written, they weren't really written to apply to an asset class like this that has these type of price movements. And so this is, so we talk a lot about right now with folks about their approach to impairment, because essentially what we have to do is we have to track all of your holdings, everything that you have, and the individual cost basis of every single lot. And if you've ever if anyone has ever prepared a FIFO, like layers, like, relief work paper, the lot level detail becomes really important. And so we need to track your cost basis on a lot by lot, not just on an asset by asset basis, but on a lot by lot basis. And then we have to we have to capture like market price, based on those pricing levers that we pulled. What's the low price for this time period? And we test all of your assets. So we'll go through, doesn't matter if you have 1, 10, or 1,000 different lots of ETH. If we pulled the low price, hey, this is the time period we selected, we're going to test for impairment. Here's what the low price was. What we're doing in the background in our system is we're comparing the cost basis of all of your assets versus what would they be at this low rate during the period, and deciding that any of them need to be impaired. Do we need to book any impairment expense? And when we're talking about I think thousands of transactions a day on a Solana validator, when we're talking about, high volume, having the lot by lot audit trail becomes so important. And so that's a big piece that was really important to us when we built this at Bitwave, is like, we have to be able to provide the user with a lot by lot level report so they can see exactly what's happening, exactly what lots are getting impaired at exactly what rates. And so that's how we've built out our impairment function. And we have a lot of flexibility, right? Like, do you want to test impairment monthly, weekly, daily, whatever it may be, we can kind of flex accordingly. But I think, to me, it's one of my favorite reports that we put out at Bitwave, is like, when you run that impairment, being able to see the lot level detail. Because when you get into that level of detail, it becomes immediately clear of like, oh yeah, without a software solution like this, it's borderline impossible to do well. And I'm curious about how Figment, approaches impairment, Mackenzie, but I want to make sort of a general point, which is like, this is what we consider like, this is the maintenance phase of your data, right? Like we've captured all your transactions, we've priced them, we've categorized them, but now you have all these holdings. And to me, the maintenance phase of the data is, okay, what did the accounting regs say that we have to do? In this case, it's test for impairment. So we have to be able to take all your data that we've tracked and all that updated cost basis information based on all the movements, and we have to apply your data set against these other factors. In this case, the low price of a time period, right? But maybe 3 years from now, the regs will be different and digital assets won't be considered indefinite life intangibles, and there will be a different rule. And so like, that's why I sort of generalize this as the maintenance phase of data, which is because like right now, the hoops that we have to jump through is impairment, but the regs change, there will be a different hoop to jump through. So like, having a system where you can take your constantly evolving data set and apply a filter like impairment or whatever the next reg is, becomes very important. I think you could probably speak to some more of the specifics with that.
Yeah, definitely. And I think it's a great point. The impairment report that Bitwave has is super powerful because it's really difficult to do this in Excel. If you have thousands of transactions, you really need a software solution at this point. You can't just do it manually on a spreadsheet. And so at Figment, we sort of anchored on impairment as like the final frontier of our crypto subledger, because once you can run in the impairment report, that means all your historical data is taken care of. And now you can keep up with your changing cost basis. You can keep up with the regs. Once you have this really clean data set, you can pretty much do anything that you need to do accounting wise. And so we think about it on a daily perspective, like running impairment daily, because we're really trying to get our transactions on a real-time basis and get our cost basis on a real-time basis. And so if you go over to the next slide, this wouldn't be an accounting webinar without some old-fashioned journal entries. So I just want to highlight that, having a subledger that can run impairment is really critical because your journal entries are actually different if you have impairment versus if you don't have impairment. So I won't get into like super heavy detail here, but pretty much this example is looking at if you have some atom and the cost basis is changing. So you buy it at one price and then the price actually drops and then you have to record an impairment expense. And then it looks like, well, when you dispose of that atom, there's going to be either there's going to be some sort of trading gain or loss on that transaction. But as you can see on the right-hand side here, if you don't have impairment, your journal entry is going to look one way. In this case, trading gain is going to look a little bit higher. And then if you don't have impairment, it's going to look a different way. And so that's why I think it's really critical to get your subledger up and running, get it compliant with US GAAP, because your journal entries will actually be in accordance with the guidance and what they're actually supposed to be. And so you can just see a pretty stark example here of how your books will actually look different depending on how you set up your subledger. And so with that, I think it's super critical to set up a subledger that's compliant with US GAAP. It is a long, somewhat arduous process, but at least in my experience and in Figment's experience, we've learned so much about how our business is operated. We learned so much about the different sorts of detail and transactions that are within our wallets. That's really, priceless information. And it does feel like accountants really are on the cutting edge since, as Joe mentioned, new guidance is yet to be released and maybe the regs will change in the future. But if we have a really good, clean data set, then we're really ready to face that challenge. And so every entity is going to have different sort of transactions, a different journey. But as long as you sort of figure out your subledger strategy, I think that's key and you're good to go with that.
Yeah. That's a great way to conclude here. I think for any accountants who are in the fringe of the like crypto digital asset world, this is a personal anecdote. I think for me, Mackenzie, I'm curious if you share this at all. It has really like sort of doubled down or maybe renewed my enthusiasm for accounting, because like you are truly like solving these issues. Like you might be dealing with like staking rewards on some esoteric chain where like you really have to go back to like the principles of accounting to like from a first principles basis of like, what are we doing here? What are we trying to record? Like, what are we, this whole process of setting this up it reveals so many of these sort of like problem solving scenarios that like, if you're a traditional accountant and, that are curious in this world, I absolutely encourage you to dive in because there's like a never ending list of things to solve for.
Yeah, 100%. I think my favorite example is when I was trying to untangle our osmosis liquidity providing activity. That was the first time I'd ever seen anything like that. So really to dive in deep and say, okay, like what's the sequence of transactions here, and how does this translate to like an account on our chart of accounts? And so that was a really interesting exercise for me to go through. But also, most accountants are probably not doing this type of work, and so I think it's really exciting that we get to do this. So accounting's cool again, which I really like.
Yes, yes, I like that.
Awesome. What an informative webinar. We'd like to go ahead and open it up to Q&A. If anybody has any questions in the audience, feel free to throw them in the ask a question or write in chat. And while we wait for some questions to come in, if there are any questions, where can people find out more about you, Joe, or get a hold of you, or figure out more about Bitwave, or dive in deeper on subledgers?
Sure. Yeah. I mean, it's pretty easy to get a hold of me. I'm Joe Dillon. You can look me up on LinkedIn, or you can, I'm joe.dillon at bitwave.io. I think, well, one, follow along. If you have this little button that says become a Figment insider, definitely do that. I have personally learned from a bunch of the content Figment puts out. I think certainly as far as like proof of stake accounting, Figment has been like so thoughtful in their approach that there's a ton of good info and from the content that Figment puts out. And there's not a ton of proof of stake accounting content out in the world. So if you're in the pursuit of that type of thing, absolutely do that. And yeah, follow Bitwave on LinkedIn or something, and I'm sure you'll get all the updates you need.
Awesome. And we have a question here for you, Joe, or maybe Mackenzie can jump in here as well. Alexandra asks, I saw the simple categorization drop down on the rule screen. What are the other choices in the rule screen?
That's a good question. So I think mostly what we're talking about with those is we have a few different categorizations type. Like simple is like you're straightforward. Hey, if this is a disposal, we're going to calculate a gain or loss. If there's a, kind of like your standard, but there's a couple other like categorization types, like maybe like an internal transfer. So like, let me give you an example. This is like where if you're moving assets from one of your company's wallets to another, like there are certain nuances to that. Like we don't want to capture a realized gain or loss on the disposal of those assets because they're just moving over to your other wallet. You're taking things from your left pocket and putting it in your right pocket. And so we want to tell our system, hey, don't capture a gain or loss for this. Like I don't want to record that. And so the internal transfer, I think there's maybe some more detailed.
There's a DeFi one.
Is there a DeFi one? Yeah, there might be a DeFi one in there. Not in the rules base. We also have options to like, categorize like invoice or bill payments. So like if you had like, say, a customer who owed you you had an open invoice for $25,000. They send you 25,000 USDC. Well, you can actually, because we're linked to your GL and your ERP, you can actually choose that customer. We'll sync in the outstanding invoice they have. You can say, yep, that's the invoice I'm satisfying. And we'll even calculate for you what we call a 4x gain or loss on the difference between like the invoice amount and the like snapshot in time value of those digital assets. So those are a couple of the like kind of examples of different categorization types.
Awesome. And then we also had a follow-up question with that. What do you find is the best way to keep up with new guidance or regulations on crypto accounting? And this is from Palash.
Ooh. That's a great question. Yeah, so a lot of the big four put out specific publications on like new guidance that came out or their take on guidance. And so one that comes to mind, KPMG just released one on staking. And this is the first time like a big four has really mentioned staking at all, because it's kind of not a more obscure activity, but just like not as popular as like DeFi or something like that. And so usually I keep up that way, just looking at the different like practice aids that are being put out. I also just look at the FASB's website a lot. I know they list their agenda there, and I think they also have recordings of their sessions. So that's a little more like in the weeds. But I see those are my two main ways. And also just like crypto accounting friends that I have in the industry. Everyone kind of hears information from different places, and a lot of the people that I know like tend to share information. So that's where I get my updates from.
Yeah, I think there's also like there's industry groups, like there's a handful of different ones that you can join, and like like one I'm pretty involved. This is the Wall Street Blockchain Alliance, where like there's a bunch of crypto accountants there that are sharing knowledge all the time. There's a whole bunch of different like kind of communities, but yeah. So I do think we are still at the phase of like you kind of have to build your own information flow, whether that's like following the right people on Twitter or LinkedIn, or spending your Friday night on the FASB website, like whatever it might be. But we are at that stage, right, where you kind of do have to take some personal kind of approach to like gathering all your info sources.
Beautiful. Any other last minute burning desires? And while we wait for those last burning desires to come in, Mackenzie, let the people know how to get a hold of you. How do we figure out, say we're interested in staking with Figment or learning about other validator services, where can people find that information?
Sure. So on the Figment side, you can just go to our website, it's figment.io. We're also on Twitter, so you just look us up there. And also the Become a Figment Insider button, which is right there. You can also click that and keep up with us that way. And then personally, my email is super simple, Mackenzie@figment.io. Also Figgy_feline on Twitter. So if you want to connect with me there.
We're all a bunch of cats over at Figment. I'm also Calico Kitten Cat on Twitter if you guys want to get a hold of me. Let's see. We got one more question from David, and then we'll go ahead and close this out. Do some companies push back against better wallet hygiene because of the additional fees required to move assets between more addresses rather than having everything dumped to a single address?
Great question.
Great question. I think, yeah, sometimes. I think this is sort of like an indication of sort of where you fit in that like sort of scale of, an organization that's doing a bunch of activity at high volume. Typically, the fees that they're going to incur for moving stuff like wallet to wallet is not material to their business, and the people hours that it saves by having that wallet hygiene outweighs whatever they're going to, whatever they would save in transaction fees. But you're right, for some small, really small organizations, sometimes there's pushback, but I think, even if you're operating on ETH, ETH can be expensive to transact on. I think it's worth it. I have yet to see like an organization whose fees of moving stuff from wallet to wallet were so exorbitant that I was like, yeah, this isn't worth it. Dump it all in one. So like it is a concern and it is something to be mindful of. But I think it's still worth it.
Yeah, and just to add on to that, I think it's less about the cost and more about the operational lift that's required because you kind of need buy-in from maybe like your product team or your engineering team. And so that might take a while to get people used to a new process. So it makes it easier on the accounting side, but this might be like a trickle-down effect and affect your actual operations. And so that might actually be the harder part to it.
Right. Which kind of opens up the window to something we didn't even get into, which is like internal controls surrounding wallet management, like seed phrase management, private keys. Do you use a custodial service like that? That operational, like internal control stuff. That's a different webinar, I guess. But like it does raise all these things, right? Like if you have 100 wallets instead of 2, well, now you have 100 wallets to keep track of and manage the security of. So David, it's a great question. That wallet hygiene piece doesn't come, there are consequences of it. So it's a good thing to keep in mind.
Speaking of consequences, what are some of the benefits to just eating the fees and breaking them down?
To me, I think it's from an accounting and reporting and sort of like audit trail standpoint. It's the idea that like, however separate you can keep things, the more visibility and more granularity you're going to have. So one thing is like I said, the people hours and in doing the bookkeeping, but also like the granularity of reporting. Like maybe you want to be able to see it's not enough for you to be able to see, hey, here's my staking reward income. No, I want to know by chain. I want to know every different, or I want to know, maybe you use different strategies. Maybe you did. So like the more you have those things sort of like delineated and split apart, I think you can get a lot more visibility into your actual like results.
Yeah, and just to give an example of that, so sometimes at Figment, we have customers that pay us in tokens. And so what we'll do is set up individual wallets for whatever chain, and then that customers are paying us tokens for. And so like Flow, if a customer's paying us, we'll set up a Flow wallet and then the customer pays there. And so it actually makes it really easy to close out our invoices that we set up in QuickBooks. So we can just look at that wallet. Has there been a payment? Then yes, we know it's from like X customer, or we know it's like for this particular service that we did. So again, goes back to reducing bookkeeping hours and just makes it really clean and really clean way to example close out your invoices.
Big brain move there. Big brain. Work
Giga
smarter,
brain.
not harder, right? Well, thank you guys so much for joining us on this webinar. I hope this is the first of many. We definitely need more news and alpha around crypto accounting in the space as regulations constantly change. So thank you guys so much for joining us in the chat there, guys. And if you guys would like to share this event or watch it again later, you found it valuable, you can use the same link that you used to join to rewatch the event. So thank you guys for joining. And until next time, happy accounting.
Awesome. Thank you.